Hi, my name is Aditya Patnaik. I am an investment advisor at Sprott. The following is a recording of a discussion I conducted with Rick Rule on the 4th of May, 2022. The conversation begins with a topic that Rick has emphasized many times, thinking about the macro, but investing based in the micro. This is particularly important today, given the very volatile nature of the markets that we're in. I hope you enjoy the selected excerpts from our discussion.
Aditya, I want to say this very, very, very strongly. Macro is how decisions are often made because the macro affects the emotion. Micro is where the money's made. Investing in companies because of perceived differences between net present value at reasonable commodity price assumptions, and the price is where the money's made. I think discussions of the macro are useful in the sense that discussions of the macro can give people a view, a probabilistic view of what the net present value of future cash flows are, because they can tell you something about the probable direction and dimension of commodity prices. But it's important that investors focus, if they're actual investors, on company and industry micro in terms of deciding whether and when to invest. I remember myself cutting my own investment teeth in the 1970s, which was a horrible, horrible, horrible time for sentiment around investing. Inflation was high, taxes were high, the economy was sclerotic, coming out of the Vietnam War and the war on poverty. And the consequence of that is that there were literally scores of companies, Aditya, that were selling for less than net working capital, which is to say that their market capitalizations were less than the value of their current assets, their cash, minus all liabilities. And scores of these companies that were net nets, which is to say they were selling for free, were cash flow positive. Ben Graham called these free bonds, meaning that you had access to their cash flow for zero capital cost because they were selling at a discount to the value of their working capital. So using the macro as an excuse to ignore the micro is a real problem. How does that impact us today? Well, it gives us the ability to frame some discussions. I would argue, as an example, that with the oil price at $100 a barrel, the oil price could easily and probably should fall to $70 a barrel, maybe 60. And I think it will fall if there is a cessation of hostilities between Russia and the Ukraine. I don't know any better than you or any better than any of our listeners whether or not there will be a cessation of hostilities between the Russians and the Ukraine. But what I note is even at $100 oil, the oil and gas industry is deferring sustaining capital investments and new project investments. Shareholders are asking the oil and gas companies to distribute the surplus cash that they're getting by way of dividends or share buybacks, which means that they're deferring sustaining capital and real project investments, which suggests that the oil price can stay higher for longer, absent a global recession. So even in that circumstance, despite $100 oil, despite the fact that we're way above the incentive price for oil, a combination of the industry being punished for past sins and the perception that the big thinkers, the Greta Thunbergs and the Joe Bidens have, that oil is somehow an evil industry, is causing the industry to decapitalize itself to the extent that I think that the big oil companies and many of the intermediate oil companies, frankly, are discounting $65 oil or $70 oil and discounting $3 gas in the face of price quotes that are substantially higher. I bring this up because it's important for the listeners to this discussion to understand that while decisions are often made on the macro, macro discussions should only be considered as providing some of the inputs for micro decisions, decisions at the firm level.
So, Rick, I'd like to start with a somewhat philosophical question that is inspired by one of the comments made by Buffett at the Berkshire annual meeting this weekend. He was asked about the inflation problem, and he was asked about the nature of the markets. And he talked about how inflation swindles the person who keeps cash under their mattress. And he also talked about how the markets had essentially turned into a giant casino over the last 2 years. In my mind, both of these are unambiguously consequences of the stimulus and the liquidity that were added into the markets in response to the pandemic. Now, arguably, these actions were needed for a short period of time, but the fact that they were not reined in, particularly over the course of 2021, when we started seeing some of the early effects, some of the early ill effects of the extent of the stimulus, made me wonder about whether it was incompetence, political incentives, or just blatant crony capitalism that was behind all of this. So here's my question. Buffett made a comment at the meeting that in his book, Jerome Powell is a hero for the actions that he took following the pandemic. I found it very odd that someone who is such a big proponent of productive assets would be so complimentary of adding huge amounts of unproductive debt into the economic machine. Where do you stand on the policies that were enacted, particularly in light of some of the consequences that we're seeing today?
I think Mr. Buffett was clearly talking his own book. He's a consumer of capital. It's in his interest to have capital made cheaper, including artificially cheaper. While he is also correct that inflation works as a swindler against savers, it does not work against spenders, including some forms of investors like himself. And further, it inures to the benefit of people who own existing assets, where the replication of those assets would be more expensive as a consequence of inflation. Think the Burlington Northern Santa Fe Railroad. So I think that you need to take Buffett's description of inflation and his contradictory advice with regards to inflation in the context of his own self-interest. I would dispute part of your own statement where you suggested that the measures that were taken were needed. It seems now that the voters and the politicians have come to the belief that we don't need to take a bitter pill on occasion. It seems that the big thinkers have decided that irrespective of exogenous shocks, we can't afford or don't need recessions. We don't need resets. And I don't believe that that's the way that markets work. I believe that the longer you delay taking air out of an overinflated balloon, the larger the ultimate explosion of that balloon is. So far from believing that the stimulus measures were needed, I believe that they were extremely harmful, if only in that they reinforced the message that there isn't a moral risk in overextended personal finance, overextended government finance. With regards to Buffett's discussion of inflation, he acknowledges that inflation is pernicious. What Buffett said is that the greatest defense against inflation is becoming extremely good at something. And he is extremely good at several things. Understand, too, that particularly in his capital-intensive franchises, that the effect of inflation is to lessen the ability of his competition to compete with him. And finally, to the extent that one of the features of inflation is negative real interest rates, as a very large consumer of capital, he is a huge beneficiary of negative real interest rates.
He's also supportive of the greenback and government intervention. because when he talks about his life, he talks about the US economy over 3 of his lifetimes. He speaks very highly of the system and the fact that it's worked in his observation.
I think very clearly, relative to other systems, it's worked. I would argue that it works less well now than it's worked in the past. But I don't think that you can argue that during Buffett's lifetime, the US system has worked better for more people than any other system ever conceived. That doesn't mean that we shouldn't try to make it better. In particular, if you look back at the last 40 years, one of the things that that very system benefited from was somebody who was very unlike Jerome Powell, Paul Volcker, who decided for the last time in my memory that the American economy needed to take the pill for inflation. The raising of nominal interest rates until those nominal interest rates became real, beginning in 1980 and culminating in 1983, was the policy that broke the back of inflation and in fact ushered in the ability that we have had over 40 years to have declining nominal and declining real and then negative real interest rates. The last time that the Fed decided that they were going to solve the problem of counterfeit currency and manipulation of financial markets by the government was 40 years ago. And the consequence of that very difficult decision, the 1981, 82, 83 recession, was a sharp and ugly recession. But it was precisely the reset that allowed us to have that wonderful period of productivity and prosperity that followed it.
So in my question, I raised 3 possible explanations: incompetence, political incentives, and crony capitalism.
The answer to that is yes. Yes, absolutely. We demand as voters incompetence. The nature of the political process is crony capitalism. The point of politics, I would say, described by H.L. Mencken, is as an advanced auction of stolen property, which is to say, if you examine the tax code or if you examine the favoritism that went into the distribution of the fiscal stimulus, you will see all sorts of evidence of crony capitalism. So yes, I would say that each pernicious trait that you described as being one that could have been identified, I think all of them were active.
Well, with that short or brief philosophical digression, I will bring this back to resource investing. Okay, so let me ask you 3 questions at the micro level now with regards to silver. I was actually reading through some of the older annual reports of Silver Standard. I think it was in the 2006 report, Quaterman mentioned you and Jim had participated in a placement with them in 1993. It was not until 2008 that they put Perquitas into production. So that was 15 years from when you started your investment journey with them. And I also noted that a lot of the exploration and development projects that they were working on over those 15 years never went anywhere and didn't become mines and are now in different junior silver companies that exist today. So you've talked about how SSR was one of your big wins. I have 2 questions for you. One is, what was your exit point in that investment? And the second question is, do you see any companies that fit the profile of SSR in 1993 today in the silver sector?
So let's examine Silver Standard, because I think it's a wonderful discussion of how micro impacts your decision making. 1993 was a very different period than today. Silver had been in an investment malaise for a very long time, really since 1986, if my memory serves me well. The consequence of that was that the price of silver was quite depressed, $4.50 an ounce. And the expectation for silver price increases were very depressed. What that meant was that there were numerous silver deposits around the world where you could buy ounces in the ground that had been established and delineated with tens of millions of dollars of expenditure, and you could buy them for 4 or 5 cents an ounce. And when Silver Standard was conceived of, or rather reconceived by Bob Quatermain, Jim Blanchard, and myself, the idea was that rather than try to beneficiate deposits, rather than try to build them and produce silver when the price was low, so that when the price rose, all we had was a hole in the ground where our silver used to be, that we would raise money from people who believed that the silver price would go to $10 or $15. We would buy ounces in the ground that were effectively valueless at $5, but could become very valuable at 10 or 12. And the consequence of that is that we were buying deposits that had been drilled off with 70 or 80 or $90 million. And we were buying these deposits for $2 or $3 million. So when you point out the fact that the deposit wasn't put into production out of the Silver Standard stable for 13 years, that was by design. When we conceived of the company, we deliberately decided that you could buy deposits at much lower prices than you could discover them. And that even if you had a deposit that was nominally profitable at $5, that the probability was that the price of silver was going to go to 15. The right thing to do then is to leave that silver very safely in a mine. And when the price got to an incentive price, that you would sell it to somebody else and let them take the risk, which is, for the most part, precisely what Silver Standard did. If my memory serves me well, we bought 11 deposits in the 1992 to 1996 timeframe. And some of them turned out to be absolutely spectacular buys. The deposit that since became Pretium, if my memory serves me well, we bought for $3.3 million. It had $2.1 million cash in the treasury. The non-producing part of that deposit just sold to Seabridge for $100 million. And Pretium itself, after $700 million in expenditures, was sold to Newcrest for $2.8 billion, all of which for a $1.2, $1.3 million net expenditure. So the delay that you talk about in Silver Standard was very much by design. At the point in time when Perkitas was put in production, the silver price had advanced by nearly triple, and the tin price, which is at least half the value of that deposit, had doubled. So the strategy of Silver Standard, which is to say buying large, well-delineated deposits at pennies rather than dimes on the dollar, and then waiting to beneficiate or sell those deposits until the point in time where the commodity price did what you thought it had to do, all that transpired. Now, as to my exit, I tend, when I really believe in a person and a thesis, to buy very large amounts of stock. And with my clients, I controlled well in excess of half of Silver Standard. If you control more than half of a company, the time that you take profits is when you can. So as an example, when the price of Silver Standard went from 72 cents to $4.50, knowing that Silver Standard was likely to have to do another financing to buy some more silver, we sold some stock. We were able to replace that stock in the subsequent financing at $2.50 with a full warrant. When that $2.50 stock went up to, $6 or $7, we sold some stock. We replaced it in a $4.50 financing. Over 6 or 7 years, that stock went from 72 cents to $45. I took a lot of profits on the way. There came a point in time where the success of Silver Standard and the market's newfound fondness for silver, in contrast to the lack of fondness for silver that had existed in 1993, caused me to sell all my stock. As the share price subsequently fell, and it fell fairly dramatically, I bought some stock back. Later on in that adventure, after cost overruns and technical difficulties at Perkitas, the board of Silver Standard asked Bob Quartermain to resign. Given that one of my reasons for owning the stock was my complete trust in Bob Quartermain, when one of the principal reasons for my owning the stock went away, the stock had to go away. So I sold it the same day that the board asked Mr. Quartermain to resign. So I hope that answers the question.
And do you see any companies in the silver sector of that profile today, or does it?
I don't, because the market's very different. At that point in time, nobody had thought of optionality in those days. Nobody had thought that you could acquire ounces in the ground for pennies on the dollar and hold them for 5 or 6 years. That was the prescription for success that we employed at Seabridge. It was the prescription for success that we employed at Lumina Copper, at Vista Gold, at Silver Standard, at Pan American Silver. So there were at least 5 circumstances where share prices went from pennies to tens of dollars. The consequence of that is that type of opportunity isn't available in the market anymore. It doesn't exist. So the profile of taking advantage of an opportunity that is unidentified by the market, but is very present, isn't, from my point of view, around anymore. The opportunities that I see in the silver space involve what I consider to be mispriced assets. An example may be Pan American Silver, where they have 2 latent assets, one in Argentina, Navidad, and the other in Guatemala, that are both 500 million ounce deposits, that are both high-grade deposits. Both are non-producing for political reasons. If either of those deposits returned to production, they would more than double Pan American's production. I believe it more likely than not that within the next 3 years, one or both of those deposits will be approved for production. In other words, I believe, I don't know for certain, that either Guatemala or Argentina will come to their senses, and that Pan American Silver will be allowed to place in production a deposit that will be in the top 5 or 6 of all the producing silver assets in the world. And I think it not unlikely that both of them will come into production. Meanwhile, the Pan American share price, I don't think gives any credit for either deposit. That's fairly attractive to me. I also see that the silver market, very much like the uranium market, has become a narrative-driven market. What everybody seems to want to buy is the penny dreadful, where the only silver that they have is in the name on the share certificate, rather than having very much by way of silver in the ground. Or if they do have silver in the ground, even if it's a large deposit, it's of such low quality, such low tenor, that it would take dramatically higher silver prices to make it work. So what I see in the silver market is that the higher quality development projects are less expensive relative to the risk reward parameters that they offer than the silver juniors that I made my name on. With regards to the silver juniors, it seems to me that they respond more to promotion than they are to drill holes. So the likely investment stratagem that I will pursue with my own money will be really threefold or perhaps fourfold. But one will be that I'll concentrate some amount of money on the high quality producers, those high quality producers that I think are mispriced. The second is that there are at least 2 high quality development plays that I think, relative to the rest of the silver silver marketplace, are mispriced. And the third is that I think that there are some silver exploration stories that are unpromoted, in particular in those circumstances where the unpromoted ones will allow me to acquire large positions with private placements and warrants, and perhaps aid them from an advisory standpoint. I don't mean a paid advisory standpoint, but rather a grand old man advisory standpoint, in how to upgrade their messaging to the public. I will definitely do that.
Okay. Previously, we've talked about small minds and your disinclination to invest in small minds because of the risk there.
Small minds can make good speculative profits in the near term for shareholders. But if you look at them as economic propositions, I've come to understand that everything that can go wrong with a big mine can go wrong with a small mine. And a small mine can never make you big money. Secondly, a big mine, if you make a mistake, an implementation mistake, can come back. So while speculators can do okay in illiquid, small, high-grade deposits because of a momentary change in perception, it's not something I'm interested in. I want the probabilities to be on my side. And the probabilities are that big mines are immeasurably better than small mines. The second part is pure geology, Aditya, and I'm sure in your career you've noticed this. Big deposits, high-quality deposits, whether they be minerals or oil and gas, always yield you surprises. And those surprises are almost always good. Small deposits yield surprises too, and they're more often than not bad. And in my declining years, I've come to prefer good surprises to bad surprises.